Over the last 2 years, gold and silver have been headline makers. Prices have risen sharply, and with that comes some renewed interest from investors asking a very reasonable question. Should gold or silver or both have a place in my portfolio right now? At Cirrus, we think the right way to approach this question is not through recent performance, but through context. Context is critical when it comes to investing. Even in relation to this post about these two commodities, while you're watching this video, remember that the prices may have changed dramatically. So everything needs to be viewed through a context-focused lens of what we're dealing with right now. Precious metals are often described as safe haven assets, but in reality, gold and silver behave more like cyclical commodities. Their prices tend to rise and fall alongside uncertainty, and today they're advancing at the same time as many other asset classes amidst questions around monetary policy, fiscal policy, and global geopolitics. That doesn't make them bad or good. It simply means they should be evaluated as part of a broader portfolio strategy, not as a standalone trade or a reaction to some headlines. So what's driving this recent surge? One factor has been the uncertainty around the Federal Reserve and the future path of interest rates. When inflation expectations rise or confidence in currencies weakens, investors often start to look for assets perceived as stores of value. Another contributor has been increased gold purchases by central banks globally, particularly as some countries reduce reliance on dollar-denominated reserves. Add that to the real industrial demand from areas like electric vehicles, solar technology, and artificial intelligence. Gold and silver begin to occupy a unique middle ground between precious metals and industrial commodities. So here's the critical point of all of this. Strong rallies in precious metals are historically very difficult to time. This isn't the first time we've seen this. We saw it in the 1970s. Gold and silver surged during stagflation, only to experience long periods of decline afterwards, and they took a long time to start to recover to their previous highs. The same pattern appeared following the global financial crisis in 2008, and again during the pandemic. Prices rose sharply during uncertainty and then reversed as conditions stabilized. That creates two challenges for investors. First, predicting gold and silver prices requires forecasting interest rates, inflation, and economic conditions, which is something history has shown is extremely difficult to do consistently. Secondly, chasing recent performance can mean buying near peaks and enduring long stretches of underperformance. This is why when precious metals are used thoughtfully, they tend to work best as part of a diversified allocation. Broad commodity strategies, for example, include gold and silver alongside energy, industrial metals, and agriculture, so that diversification helps to manage the volatility inherent in individual commodities. Precious metals can offer diversification benefits because they behave differently than stocks and bonds, but they also have limitations. They produce no income, they don't generate any revenues or anything like that, they're difficult to value, and they can experience pronounced boom and bust cycles. Allocating to them can mean sacrificing long-term growth from equities or fixed income, and so the key takeaway here is really simple. Gold and silver may play a role in certain portfolios during certain environments, but their value comes from how they fit into a diversified plan, not from recent price movements or media excitement. At Cirrus, our focus is on building portfolios designed to navigate a wide range of market conditions rather than concentrating in whatever happens to be working right now. Our goal is to navigate bear markets and sideways markets, not just bull markets alone. In our opinion, discipline matters far more over time than any single asset class.